everybody, welcome back to another video. So today we're pretty much just going to keep covering the topic of Confluence trading, where what we simply do is grab a bunch of technical indicators together and we simply look at the probability of the outcome of a specific trade. So what I'm going to be covering is how you could have pretty much just caught any of these past moves and how you can implement this into the future to make a profit, to make money off of these trades. So really what I'm going to focus on is this move right here. I'm going to be breaking down all of these moves here. So pretty much when you actually take your first look at GJ, right, you want to set up your main levels of support and resistance, your main levels of supply and demand, which right here we can identify we have a level of supply, meaning support. So once price actually came down into support, right, notice how price grabbed liquidity and immediately had a big rejection to the upside. So it was kind of like price came into the zone and then right away rejected and went in the opposite direction. Now, keeping this in mind here, how price came all the way into the zone, had a big rejection, and then price closed as a bullish engulfing, shows us a sign that price had came down and grabbed liquidity yet again, and support was heavily rejected very strongly. Unlike over here with current price action, yes, every time price came into the white zone, you could have looked for a potential buy opportunity, but it wasn't strong like these. Notice how it only took maybe 2 days for price to reject. Here it took multiple days to have a real big rejection out of this level. Even though, yes, price did reject the level, it took multiple days for that to actually play out. Now, when it came down to price actually coming into the zone here, rejecting and then closing with a medium probability bullish engulfing candlestick, what you could automatically expect is for the next level of resistance to be retested on the daily, the nearest level of resistance, which is all the way up here. So this should be a target or a point where you see price traveling. This should be a projection. Does that mean you should take a trade right here? No, we're going to break it down to a lower time frames and look for real trading opportunities. So pretty much that bullish engulfing was a combination of these two candlesticks right here. Here for you to actually take an entry at this point in time would have been a very, very aggressive entry, which I don't necessarily agree with. Now, what we're going to be doing is combining our knowledge of supply and demand and support and resistance, right? So I'm going to get rid of this line here. So we know that this zone right here is our level of supply. We know that we have a bullish engulfing on the daily. Just based off that bullish engulfing on the daily time frame, right, we're starting to look to combine everything together. So what do we have on the daily? On the daily, we have a big rejection of support and a bullish engulfing. That is an indication to look for a buy, right? Now, when it comes down to looking at the 4-hour time frame, what we could see is that here we have support and here we have resistance, right? So we have support. This is a 4-hour level. We have resistance. And let's just pretend we aren't here yet. So what else can we actually spot? We also have a level of support and resistance here as well, right? So what we're looking at here is price actually reject daily support, come back, hit daily resistance where they were met with a little bit of selling pressure, and now price is slowly but surely look at this, rejecting 4-hour support over here. Can we look for a trade opportunity here? Yes. Why is that? Because price is at a level of support. And what we could potentially look for here is look for an entry above support, right? And our stop loss under support and target the same level of resistance, right? So when it comes down to it, we already have a confirmation of buy, 2 confirmations to buy really on the daily time frame. Me personally, I would use that as one confirmation on the daily, right? We have rejection of support and a bullish engulfing medium probability. If it was a high probability engulfing candlestick, then I would make that 2 confirmations, but since it's a medium probability engulfing candlestick, I'd make that 1 confirmation. You could do what you want. It really ultimately is up to you and how well you, I don't want to say position the trade, but how you put more power, if that's how you want to call it, on the specific price point. Maybe power isn't the best terminology, but where what it means to you basically is the confirmation. You know what I mean? right, is a rejection of support. Does that mean a lot more to you than the actual engulfing itself? It all depends on the individual, and that's something that you just have to determine as a trader, right? We're all not going to have the same pedestal for specific confirmations as the next trader. So now let's take a look at the market structure here, right? We see price come down, come up, come down, come back, retest the high, and now we're trading at our previous lower low point, where we could see a rejection as an inverted head and shoulders pattern. Notice how price rejected resistance, and now with this candlestick rejected support. So H4 is in a little bit of a range here. What we could do at this point in time is break it down to an even lower time frame, such as the hour time frame. What you could see is price pull up, pull back into support, big engulfing, pull back into support, big engulfing. So what this shows us here is that buyers are interested in this level of support. And what could you have potentially done? You could have pretty much used the hour time frame and the 30-minute time frame, because again, we're looking at a combination of time frames here to look for an entry at either of these points after rejection of support. Ultimately, how you're going to enter is up to you as the trader, right? Some people might enter right at the first rejection being here. Some people might wait for a strong entry confirmation. Me personally, I would have taken an entry off of this pattern right here, this double bottom pattern right off of support. So what we're going to be looking at here is, let's look at the 4-hour time frame and the 4-hour moving averages. Right now, price is kind of in consolidation here, right? Yes, at this point in time, it's red over blue, but price is trading above the 20. If we pay attention to the moving averages on the hourly time frame, though, what we're going to most likely see is a blue over red SMA. Now notice how price is riding above that 50 SMA quite nicely, and it's blue over red. So we're already starting to have more than 3 confirmations, but as of right now, it's still a type B setup. Now if we go to a 30-minute time frame, what we could see is price actually come back, and we're still bouncing above support. So we know as traders that we want to buy at support and sell at resistance. In a case like this, the probability is a lot higher for price to actually go higher. Why is that? We want to pay attention to this bullish momentum here. This is that big engulfing candlestick on the daily. Notice how we broke above these highs, and we actually broke above previous resistance here, because notice how here was support and here it was resistance. Once price hit this level here, it went up. Once price hit this level here, it went down. Right? Notice how it broke above resistance, and now it's holding as support. So immediately you should say that, on the daily time frame, price has the highest probability to come up to here, right? And on the hourly time frame, what we could see is that price is bouncing off support time and time again, right? And you have to keep in mind, the daily has a very big engulfing candlestick, right? Again, showing you that the probability for price to go up is already a lot higher, because we rejected a key level here, being this level of supply on the daily. And I just want to stress that enough. Don't forget where you are on the daily. This is why I would not be looking to sell, because the daily literally just formed a big engulfing candlestick with a big wick rejection. When you see a big wick rejection on support and then you see engulfing followed up after that, that shows us that there's a lot of buying pressure in this area. So if you missed out on this first buy opportunity, this is your second chance entry, right? Is a pullback, right? Can we potentially use a fib from this point to this point? Yes, we pulled back 38.20%, and we're consolidating above the 38.20%. This was the 38.20% pullback right here, right? Along with that being said, look at all of this rejection here as well. Notice how price, every time it came into the zone, it rejected. So what's the best thing for you to wait? Wait for price to come into the zone and reject again. Notice how the moving averages are blue over red. We already have 4+ confirmations, being the engulfing on the daily, the rejection of our daily level of supply. We broke above resistance, and now resistance is holding as previous support. That right there alone is 3 confirmations. We have the blue over red moving averages. That's 4 confirmations, right? So this is already starting to look like a potential type A setup. Now we look at the 30-minute time frame. We could use a 30-minute or the hour for entries. It just depends on the individual. I would have personally entered at this point right here, after the thing is, if I wouldn't have taken an aggressive entry here, which wouldn't have been the smartest option, and then if I wouldn't have taken the entry here, this would have been my next point of entry. We would not have taken an entry here because the size of the candlestick, it moved too far away from support. We would not have taken an entry here. We would not have taken an entry here because, again, it moved too far away from support. Right? If you're waiting for that confirmation candle, there's no entry for you here. There's no entry for you here. There's no entry for you here because price moved too far away from support. Right? Our goal is to try and get in at support as close as possible. Now, there's going to be times where you're not going to be able to take an entry, right away, and you're just going to have to be patient and hope price pulls back and actually retest support, which most of the time it actually does, right? But there's no possible way for you to have taken an entry previously, right? Now, again, we already have 4+ confirmation, so all we need is an entry confirmation, and it is a type A setup, right? This would have been my entry confirmation here, a medium probability bullish engulfing candlestick, right? Notice support being rejected 1, 2, 3, 4 times. Then we have a 5th rejection with an engulfing candlestick, right? So this would have been my entry point here. Now you have to remember, you have to ask yourselves, before you enter the market, where are you going to get out if you're wrong and where are you going to get out if you're right? I've determined that, again, we want to place our stop loss under support, right? Notice how far away price is from the average wick. The lowest wick we see at this level of support is right here. And notice how far away our stop loss is from that. This is a very nice, comfortable stop loss because even if price does come all the way back down to here, it's still under support. But we know at this point, if price is trading at this area here, right, then we want to get out if we're wrong. Why? Because price at that point in time is probably forming an engulfing on the 4-hour and the daily time frame. And at that point in time, right, the probability of price continuing to come down to our main daily support is a lot higher. Why? Because price is breaking under our 4-hour and our support being right here. Right, this is what you call an intraday level. These intraday levels are also just as important as our main levels, right? So we've already identified that this is where we're going to get out if we're wrong, because again, if price breaks under this zone, under support, it's most likely going to continue to go down, and we want to cut our loser as fast as possible. And we're going to target all the way up here for about 6 times our risk. Right, because again, we're looking for that confirmation on the daily time frame. We're looking for price to hit this area on the daily. Now, not right away, but after a few hours, you would have seen price actually go up in your favor, and you would have been up at most 3.4 times your risk, which ultimately it's up to the trader if you want to take profit at that point or not. That's how you could have caught the first position. Now, I would have used a 2% risk on that trade. And again, now if we look at let's just even go to the 4-hour time frame. What we see is a bunch of wicks, bunch of rejections to the downside, and then notice the nice big engulfing right here, right? Nice big engulfing right here. Let me get rid of that trade, right? So that was one example of how you could have caught this move right here, right? Notice the nice big engulfing. And if you didn't want to take a trade, because the thing is, if you would have targeted this daily level, that would have been more of a swing position, because it's a lot bigger of a move. It's going to take a lot more time to actually play out. What you could have done instead is point A, point B, right? Since this is a 38.20 rejection, you could have just looked to target this negative 27 extension level. I believe our entry was somewhere along this area right here, I believe, right? Let me undo that. Stop loss goes under support around the 50%. And then even if our second take profit gets hit, right, because you can't take this trade anticipating the first take profit. That's like a 1-to-1, which is acceptable, but it's not optimal, right? If the second take profit would have get hit, then you would have made 2.4 times your risk. And if you look left, what do you see here? Support, support, resistance. And then we met resistance here, right? So that target would have been hit quite nicely, right? And then, the third target eventually would have gotten hit, but realistically, not many people would have held that trade. Now, let's continue, right? Notice this black line here, right? After price closed above support, what could we see? We could see that price broke previous resistance broke previous support. Notice how we have support. Notice how we have resistance. Notice how price also broke above the moving averages, right? We're trading above the 50 SMA, which is an indication that we could potentially look for a buy. What does a daily time frame look like? We have a nice bullish variation pattern right here. Notice how we broke above the previous day's high. Notice how we broke above this day's high as well. Now let's take a look at the daily highs and the daily lows, right? So notice this is on this candlestick, this is a lower high. Why is this a lower high? Well, if we look at this day, it's lower than the previous day's high. And this is a lower low. Why is this a lower low? Notice because on this day, it's lower than the previous day's low. Now, I'm not saying these are your major market structure points, but what we're doing is candlestick analysis. Notice how we started going from lower lows to lower highs to where we had a lower low here, then a lower high, price closed, then a higher low, then a higher high. You see the transition there, how the wicks got higher and higher, right? And how each low started getting higher as well. That's candlestick analysis, right? You have to look at the daily time frame, see how this daily time frame is forming. Either way, notice how price again closed above resistance. So we have an official break of structure. We also have a 3-leg extension. Now again, for those of you who went over the market structure section of the course, what is a 3-leg extension? A 3-leg extension confirms a new trend. Why? Because price made a high, then a higher low, and then a higher high in this situation. Right? Now, notice how price broke above resistance, right? What we could also do here is pull a Fibonacci retracement tool from the lowest point to the highest point, which you could see that price pulled back to the 618 and had an immediate rejection. Now, me personally, I like to use a 30-minute, right? So this, again, is another intraday level. It is not a major level, but it is an intraday level. Notice support, notice resistance, now price broke above resistance. What this candlestick would have showed you right here, this bullish candlestick, is that price came down into support and rejected. That is your first sign of a buy. What type of setup is this? A break and a retest. Notice how support held here. What you could start doing at that point in time is looking for buys. We already took this type A setup here. We had 4+ confirmations. What are the confirmations on this trade? The daily is making higher highs and higher lows. Another confirmation, 3-leg extension. This is possibly the pullback and you're looking to catch the 5th leg. Why is it the 5th leg? Because remember, we're looking to buy on the higher high. We're looking to buy on the higher low. So this would be the higher high here. This is the move we're looking to catch, right? 1, 2, 3, 4. We're looking to catch the 5th leg here. So you're looking to buy somewhere along the 4th leg of the extension of the trend, right? All we're simply doing is anticipating when that 4th leg will end, where we can look to continue to actually take a buy position. Now, in terms of confirmation, we have the daily time frame showing us higher highs, higher lows. We can get all of our confirmations honestly here off the hour time frame. So we have a break of structure. 1, we have a 3-leg extension. 2, we have the blue over red moving averages. 3, all we're looking for now is a pretty much an entry signal. 4, we also have the 618 rejection on the Fibonacci retracement tool, right? And again, what could you potentially wait for here? Go to the 30-minute time frame. Our best bet is to look to enter around this horizontal line that I have here, right? So again, this is support. Notice how we also have support here, right? I'm going to get rid of fibs, but just keep in mind that we're still at the 618 level, right? All of this is support. Price is still trading above support. Even though it looked like it broke here on the 30-minute time frame, remember, support and resistance is a zone, right? This is the zone in theory. Notice how price came into the zone, rejected the 51 SMA, and then we had a bullish variation pattern. That right there would have been your entry signal. I'm going to buy right here. Where's your stop loss going to be? Under support. Where's your target going to be? Resistance. What you could also do, again, pull your fibs. If you don't have a very clear idea of where you want to target, pull your fibs. Use an extension level, right? Look at this. You're going to get 2.3 times your risk. Even if you lower it just a little bit, which you could, you're going to get roughly 2.5 times your risk. Now what is this? Price rejected resistance twice. Again, increasing the probability of the trade. When price rejects resistance multiple times, it shows us that sellers are trying their best to break, or my apologies, support. It shows us that sellers are trying their best to break support, but they simply can't because buyers are too strong. Sometimes they will break support, but we're pretty much betting on that support is going to hold because the probability of the buying pressure is there. We see buyers reject time and time again. Now, when you have momentum like this, because again, notice how big this candlestick is compared to the bearish candlesticks, right? Momentum came into the market. We have a nice double bottom, meaning we have two rejections of support on the 30-minute time frame. That is our entry signal. It is a high probability bullish variation. And notice how price went up. Again, that was another type A setup. And that's it, right? Now, we can even look at like the 4-hour time frame, right? And keep in mind, right, this is still support. Notice how price rejected support, right? This is going to be a little bit trickier because some people might be thrown off here, right? Because of the big bearish pullback and the break under the moving averages and this engulfing. When you see something like this, you always want to consult with the higher time frames. When you're a little bit maybe indecisive on where price might go, consult with the higher time frames. What does the 4-hour tell us? Well, we had a big move to the upside, but keep in mind on the 4-hour time frame, we haven't made a 3-leg extension yet. So what is this showing us? A pullback. It is a simple pullback. Remember how in the trend section I talked about there's going to be trends within inside of trends, right? On the hour time frame, it looked like price could actually start a new trend. Why? Because of the size of the pullback. But keep in mind, this black line is still that 4-hour level of structure. And what you could do as well is, remember, you could draw a zone, right? What you could do is go from the wick all the way to the body. And if you drag that out, you see it play out so clean on this 4-hour time frame, right? To the point where it doesn't even look like price really broke under support, right? So here you have the zone right here. What does it show us? Rejection. This is where we took that first buy. And by the way, when you always want to be flipping through time frames, right? When you would have seen this engulfing on the 4-hour time frame off of this level of support, right? Again, what does it show you? Break right here, retest, engulfing. You could have looked to buy right there again. This would have been even more confirmation for you to actually hold your buy position because we bought somewhere down here while this 4-hour candlestick was actually forming and then price flew up. Now, again, blue over red moving averages. Your first sign to buy is when price rejected support right here and then price formed this engulfing. That would have been your first sign to buy. So let's highlight the engulfing, right? This is our first sign to buy right here. Go to the hour time frame. What does the hour time frame look like, right? Because we're still looking to take a buy position, right? So pretty much price rejected support, continued to trade higher, then pulled back, and then it gave us a bullish variation pattern. Now in this situation, I would go to the 30-minute time frame just so I could see a little bit more detail with price and really see what's kind of going on here, right? So your first indication really would to look to buy is right here in this 30-minute time frame. Why? Notice this level of structure and notice how price broke above this high. This is what you call a counter trend. Notice how we have a low, lower high, lower low, right? This is called the counter trend. Low, lower high, lower low. Now we know on the 4-hour time frame we're still just in a simple pullback. Now let's go to the 4-hour time frame. Let's pull out a Fibonacci retracement tool, right? Where did price pull back to? 38.20%. And again, we're trading above that 50 SMA. Let's go back down to the 30-minute time frame, right? Let me try and find my spot here. So we're all the way to the left. Let me go back. So we already took two type A setups there, right? So notice how we have, again, this previous market structure high. Let me get rid of that line because it's not straight, right? Notice how here we have our previous market structure high, and then here we also have support and resistance, right? Notice this resistance that we have here. Notice this minor support. Notice resistance here, right? Once price actually started trading above resistance and getting higher and higher, here you have a bullish variation, then a pullback. Notice again the attention to detail, right? Notice how price came down, tested this previous resistance here, where we have this resistance here as well. If you'd like, you can draw out a zone just to make things maybe a little bit less complicated. In this situation, I would draw out the zone from exactly where resistance is. I'm going to draw it from here till it engulfs pretty much this high right here, right? So this is resistance. Notice how price broke above resistance, came down, and held a support. This is where you could have actually looked to take another buy opportunity. You could have bought right here on the 4-hour time frame and look for a swing, but the issue with that is your stop loss would have been absolutely massive, so there should have been like really no trade. But now here, once price actually broke above resistance, because notice again how 2 candlesticks closed above resistance, this was the break. Notice the cross of the moving averages being blue over red, another indication to buy. Remember, we already have the bullish engulfing on the 4-hour. We're really just waiting for a pullback to look to actually take a buy position, especially if you didn't buy right here, right? And then on top of that, look at this engulfing right here. This could have been your entry signal, right? Now, realistically, if you would have entered there, we know our targets are going to be somewhere up here. Where's our stop going to be? Under support. Where's support? Right here we have resistance, right? So let's actually put our stop loss under resistance, right? I'm also going to put my stop loss under this red moving average here as well, just to give price a little more buffer room, and we're going to look to gain 3 times our risk. And this is a type B setup because we don't have as many confirmations. We have about 3 confirmations here, being the break of structure, the cross moving averages, and then the engulfing. So I'm only going to risk 1% on this position, right? And anyways, guys, that is Confluence Trading 2.0. Notice how I'm tying all the time frames in together. Remember, once you start getting confused, just bump it up a time frame. See what you see there. If you don't see anything really and you're still a little bit confused on direction, bump it up another time frame higher and see what you see there. If you're still confused, bump it up a time frame even higher and see what you see there. Now remember, like, it's exactly what I'm expecting here. Price rejected support, so the probability of price coming to resistance is very high. So let's see if price can actually hit that level. If it doesn't and it comes back down to support, then you look to buy again. If it breaks support, that's when you start looking to sell. But again, there's going to be prices and levels that are more desirable to take trades. When you talk about swing trading, you really only want to take trades at certain levels versus intraday trading. Intraday trading, you could take trades at intraday levels, but just know you have to hold them like an intraday trade. Anyways, guys, I'll talk to everybody in the next video. Yo, what's good, everybody? So in this video, what we're going to be covering today is pretty much our entry levels and where we're going to be looking to take trades from. So when it comes down to looking for these entry levels, we're only going to be entering trades off of these very specific levels because these are going to be the highest probability trades that we could potentially take. Now, when it comes to these higher probability trades, this is typically when I like to use a lot of size in my position sizing when taking these trades, because again, the probability is outweighing the negativity of the specific trade. So the first thing that I want to actually cover is a trending condition. As you guys can clearly see here, this is silver, by the way. So XAG USD, this is the commodity silver. What you can actually notice from this chart is that price has been moving sideways since pretty much, what is this, 2020? So price has been pretty much moving sideways since 2020 at its original highs at almost $30 an ounce, which is crazy to see that silver hasn't been able to break $30 an ounce. And now it's 2021 December, and it looks like it's going to go down to its original lows. That's besides the point. So what I actually wanted to cover basically is a trending condition and our best opportunities where we're going to be looking to enter within these trending conditions, right? So typically when we see a trending condition, we're going to see market do something like this, where it's making higher highs and higher lows, right? Your best trading opportunity or entry zone is going to be all throughout this range here. Mainly this top range is where you're going to be looking to start taking your buy positions from. Again, pretty much just waiting for price to actually come into the zone where you would be looking to take a buy and looking to target probably your previous high here. I kind of wanted to get that out of the way. So when we're actually trending bearish, lower low, lower high, lower low, our best entry opportunity is going to be at our previous lower low, looking for price to form that lower high where we could actually look to take that sell position there as well. So what we're going to be covering again is going to be our entry zones. And the very first thing that we have to do are mark off our major levels of supply and demand and support and resistance. So again, how we do that and how I like to do this is basically looking at the bigger rejection areas. So the first one I see is right here. We have a big rejection, another big rejection at the same level. Rejection here, here, then here, as you guys can see. So that's where I'm going to be placing my first level. And how I'm going to place this level, I'm going to lock it first of all. I'm going to go into settings and then put daily at 22.00. We'll put 22.00. Right, it's not $22 flat, but it is 22.1. So this is the first level I'm actually going to put. I could even maybe put it down here, probably a little bit lower. So let's unlock this. Possibly even right here would probably be a little bit more accurate there as well. So I'm going to actually place this, let's just do it right here, just maybe a little bit lower. I'm going to lock it. So that's my first level, and again, I decided to actually place that level here because of all these rejections. So initially, when price is actually going to be able to go down to that area, we're going to be able to look to take buy positions from that area. That's my first initial reaction that I'm getting from that specific level. Now that we have our first level actually placed, we pretty much are starting to set a foundation for where we could actually look for future trades. So I'm actually going to look to set another level, which is going to be up here. We could even say right about here. We could set this level. So I'm going to set it here, and I'm going to make this, let's see, what could it be if we take it up to 25? 25 would be a little bit high. So I'm going to leave it right there. Again, we're going to lock it, and we're going to type daily, this is 24, almost 25. Right? Now, it's probably better we put 24.8. We're going to lock it there, and now we have our second level placed. I decided to place that level where it is, mainly because of relevant price action, where we see this rejection. Then we have support. Again, look at that, support. So notice how once price actually broke under and came back above, the best thing for you to do in this specific situation is wait for price to actually come back down, test it to see if it would hold the support, and your job is to try and buy somewhere in this area here so you can actually make money off of this move here. So if I were to just go to like an hour time frame where I could break that down a little bit better for you guys, you could see, right? So notice how on the hour it looks a little bit funky, right? But if you were to go back up to the daily time frame, it looks very, very clean, a retest of that area and then a continuation back up. So let's go back to the hour so you can see it. You can see the big differences there. Right here. So look how many times once price broke back above, it retested this area and it held. So your job is to try and get in on a buy in this area as best as possible. Also notice how price is actually trading under here. That's because this is a level on the daily. If the hour closes under, then that's perfectly fine. It's not always going to look perfect. You have to remember, this supply and demand is going to be an entire zone. It's not going to be a specific price, but more or less a zone. We like to use specific prices so we can get an entry as best as possible when we're looking at the higher time frames. So your job would be to look for an entry somewhere along this area here, right? And the thing about looking to enter, right, all time frames have to be in sync, right? The daily time frame has to be in sync. If you see price on the daily time frame, we're looking at this area here. If you see price close right here at this area on the daily time frame, then you could be like, okay, well, price already closed on the daily here, so the next day could engulf. Whether this day is just fluctuating, which is most likely going to be the case, right? It's not ready to go up. The next day has to open up, form its lows, and then it could actually go up and form the highs. So it's all about timing and patience, right? Because notice how you could have taken an entry off of this level. Again, once price closed above on this level on the daily, you wait for the pullback to this level, where sure you could have taken intraday trades like, hey, we're going to sell back to this level here. When it gets here, we're going to look to buy, right? Sure, you could have done that, right? But let's just say you take a long position here, you take a buy somewhere along this area here. you put your stop loss under the lows, and you actually target the highs up here for 3 times your risk, right? Let's see how long it actually took for this trade to actually play out. So for you to even be in profit, it took about 7 hours. Then for you to actually be in profit where price is finally going in your direction, it took about 14 hours. And then notice how price actually went up. So it took about 20 hours for this entire move to actually play out, which I have zero problem with holding a position for that long if I'm going to make the money off of it, of course. Right, patience is a big thing when you're taking trades off of these major levels, and you have to be able to hold your trade through. Right, so now again, it comes back down to our entry candlesticks. We're going to be looking for price to trade around these levels, and we're going to be looking for signals like this: engulfing number 1, engulfing number 2. This is actually a super strong buy signal, especially that we're trading at this level of support. Super strong buy signal here. Right, why is this? Because again, look at the rejection there is to the downside, and then notice how buyers brought price all the way up past the open and closed within the top 1/3 of the actual wick from the open to the highest high. Notice how price closed that strong. That is a super strong entry signal. It's a high probability entry signal. And then notice how it closed above this range here that I did as well. Then price gave a little pullback and a continuation higher. One thing I want you to pay attention to in detail here is notice how price closed here, then price closed here, then price made a low here and made a low there. So just pay attention to this detail and this market structure within this hour time frame. What does this look like to you? Right, your initial reaction should be that looks like a higher high, higher low, higher high, higher low, meaning that the 15-minute and the 5-minute time frames are making higher highs and higher lows. These are very strong signs of bullish momentum, and that price is going to continue in the opposite direction, right? So again, notice the break above this high here, pullback, retest, and then engulfing. This would have been another sell or another buy signal right here, a high probability engulfing candlestick. Now, if you would have taken a buy there, what you could have potentially done is taking your buy here, your stop loss go a little bit under support and a little bit under this low here. Then you could have had the same target or even targeted the actual high itself, which would have definitely been hit way later on. But I just wanted to show you guys this, right? So let's kind of erase that. Now let's kind of continue. So that would have been, again, that was an area where we're going to be looking to trades. This is where what I call our entry zones. Anything in between, you're going to have to really focus on an intraday perspective. Now, notice how, let's just say we're on the daily time frame right now currently. Let's take a look at closer price, because we have our long-term areas where we know we could look for reversals, and now we're going to look for our short-term areas. So notice how first reaction right here is that price is currently trading at a level of support and a level of resistance. So notice how price so far is already rejecting this area right here. Right, notice momentum significantly slowed down. I'm going to actually lock this as well. Right, we can even go to a 4-hour time frame, see what's going on here. So notice how last time price was trading in this zone, we had a big move to the upside. But one thing to keep in mind is that price is making lower lows, lower highs, lower low. Right, so now we're setting our more major levels on the daily time frame. Then we're going to set our a little bit more minor levels on the 4-hour time frame. So unless price breaks these two levels, then what you're going to look for is to set other levels that are a little bit higher or a little bit lower than when you have your two main levels. Your two main levels is what I call the foundation. So I'm going to look for another price where we could see the market actually be indecisive at. And I'm going to come to the conclusion that that's actually going to be right about here. So 25. So that would be the next area where we could look to actually target, right? Which would be, again, another entry zone, right? So this is going to be daily 25. Close that. And then let's look for one more, which my immediate reaction is going to be this next level of support. So, okay, if you have trouble ever looking for levels, just zoom out. Once you zoom out, you'll see the bigger picture of things. So yeah, definitely right here would be my next level. I'm going to put another level right here, which is going to be 18. Can we get 19? Yeah, we can put it right here. So 18.95. Let's kind of zoom in a little bit. That's perfect. So 18.95 is going to be my next level. 18. We're going to do daily 18.9. And again, we're still setting up our levels because it's also important because these levels are going to be our same targets, right? But I want you guys to have your higher time frame foundation set up first. So yeah, this level is fine there. Let's go back to current price action, which is going to be in this area here. So we have our foundation, which is going to be here and here. And then we have our other levels where we could wait for price to actually continue to go up. We can even put one more on the top. We could put one probably, yeah, right here is good. This is going to be 28. So daily 28. Press OK, and we lock. Okay, so now we have our foundation. Now we have our more major levels where we could look for indecision. Now let's go get into our more minor levels so we can actually look to take day trades off of these levels. So when you go to the daily time frame and you look at more relevant price action like this, you'll actually start to see more minor levels here. And what you can actually do, what I like to do is actually draw zones. So I'm going to draw a zone from this point to this point. Right, and then you'll be able to see small indecision with price. So notice how price currently is at a level of support. How you would really set up your trades is, okay, price is at support, right? Price is currently trading at support right now. So I'm only going to be waiting for one or two things. I'm going to wait for price to see if it could pull back up into this other zone, which again, if you go on the daily time frame and you look at it, we have support, resistance, resistance, support, support, and then we have a very clean break, right? So this is a major level with inside of our current price action, right? And again, we're taking trades off of these levels. Notice how we have resistance, resistance, support, support, support. So this is a more major level within current relevant price action where we will be taking trades off of. So now that we have our entry zones, we know that we're only looking to take trades with inside of the zones that we currently have set up, right? So really you have one or two options. In a situation like this, how the weekly closed with a very strong bearish variation, right? We have actually even weekly support right here. We're going to have to see because the month is about to end, which I'm not trying to bring in, you know, other topics, and I'm just kind of trying to focus on our entry zones here really. But looking at how prices rejected the highs, we could definitely see a little bit of a steeper pullback for commodities. And in a situation like this, right, we could actually see silver pull back to about $20. But anyways, let's kind of just continue with the video. So again, now that we have our zones marked off, we're really only going to be looking to take trades off of these levels here. So now that price is currently, my bad, I had to pause the video. But anyways, now that price is currently trading with inside of these zones, again, I'm going to repeat this one more time. These are going to be the levels we're going to be mainly looking to take trades from. Why? Because we're taking trades at levels of supply and demand, and supply and demand is the way the market moves. We shouldn't really be taking trades at any other level, right? There's going to be levels that are more important than specific levels. Like these major levels are going to be more important than this level or this level. But these are going to be our intraday levels, and we're going to be using these as entries, stop losses, and targets, which right now I kind of just wanted to go over the entry zones. So these are going to be all of our entry zones, and these are going to be our more relevant entry zones. If you missed a trade and you didn't take a trade from that zone, then you're not looking to take a trade there. Just wait, come back the following day, right? So, I mean, there's many ways you can actually play this. Like here, there's a minor level of resistance on the hour time frame. I don't know if I personally would have taken a trade here. That's just me. but there's multiple things you can actually wait for nowadays. So one thing, well, not nowadays, but there's multiple things you could wait for, and how you could actually set up your trades around these areas is, okay, I have two options here. Price is in a very strong bearish condition as of right now. We know the weekly time frame has just closed, so most likely what's going to happen is a pullback. Where could we pull back to? That's going to be a great question. So a more major level would be to wait for price to come all the way up to 23.8, which is where we have this zone here, which we can then look to actually sell back down into 22 or 23 flat, where we could actually take profits at, right? Or what we could wait for is a break of this level, a retest of this level, and look to take price all the way back down to 22, to this daily level here. That's how I would be doing things. But again, these are just simply our entry zones on the daily, on the 4-hour time frame. You can also have like your hourly intraday moves, right? This is really going to be more or less for like very tiny moves, right? You can have a break and retest of the support here. So this is an intraday level. So you know that you could actually potentially look to take price from here all the way down to this low here and set up your risk reward however you'd like. But those are just kind of intraday levels. I'm not really looking to take trades at those very minor levels because the probability just really isn't that great. We're only really, again, looking to take trades at more major levels where the probability is a lot higher, right? And what we could do is look for entry based off of those smaller time frames. There's, again, many ways that you could actually be taking trades from here. Let me give you another example. So I'm going to move over to gold. Right, when it comes down to gold, if you look at the daily time frame, right, maybe like if you're a little bit newer, you might not be able to spot the trade very easily. But this level, 1795, we have resistance, 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 support, support throughout this range, resistance, right? Notice how price actually came down, closed under 1795 resistance. If you go to a 4-hour time frame, you can see a nice sell signal right here, bearish variation pattern. What do you do in this situation? Well, price was trading down here at one point, so let's just actually wait. And by the way, this big wick is actually just news, right? The best thing for you to do in this situation is wait on the hour time frame for price to pull back into our 1795 level, where we can look to actually take a sell. Now you ask yourself, okay, well, where could we possibly sell to? Well, we could actually look to take a trade, and again, I'm going to use a long and short position. We're going to look to take a trade here at the level. We're going to put our stop loss a little bit above the level, so about maybe 50 pips. Let's leave it at, right? And our take profit could be down here, right? So I'm actually going to give it a little bit of a bigger stop just because gold, again, has a lot of volatility to it recently, as you guys could see, right? I'm going to give it a little bit of a bigger stop, about 80 pips, and I'm going to look to gain 4 times my risk on this position. Why am I targeting 1760? Because that is our higher low point. That is our low for November. This is the higher low for November. That is the lowest price that price has actually reached within this specific month. So that's actually going to be my target. And again, all I'm doing is setting up different areas for me to actually look to take a short. If I'm wrong on this position, this is very strong bearish momentum, right? We've pulled back almost practically 100% from the actual move of November. So most likely, again, the probability outweighs the probability to go short outweighs the probability to go long on this specific trade. And again, you just have to ask yourself, why is the probability higher on this side than this side? Well, you have a big bearish move that's pulled back all the way back into support, and then you have a big rejection of the November higher high from October 21st, which the November higher high is also here as well, which is insane. So it's just you building a case as to why you're going to be taking these trades, right? So last but not least, that pretty much sums up the video, and that's how you'd really set up your trade. So hopefully you guys understood the entry zones. In the next few videos, we're going to be looking at specific entry signals. And again, these are going to mainly be trades based off of higher time frames, such as the 4-hour, the hourly time frame, where we could look to take these positions. And if you're someone that's like, okay, well, silver's at support right now, I'm going to buy support and target resistance, That's perfectly fine too. Look what happened last time silver was at this level here, had a big move back up to resistance. Is the probability for that to happen again? Likely, yes. Why is that? Because the market tends to repeat itself. It's as simple as that. So you're really just planning out how you're actually going to be taking these trades. So there's going to be multiple people taking multiple trades. Some people are going to say I'm going to buy silver right now up to this zone here, right, where I'll look to probably sell. If we reject this area, great. Some people are going to be like, well, I'm just going to wait for silver to come up into this area here and then look to sell back down into this area. Great, that's a different trader. Some people are going to be like, I think silver's going to break this area, so I'm going to wait for it to pull back into the area where I'll look to sell again, and then I'll target the next level of supply and demand, which is way down here. And that's just absolutely great. You know, everybody's going to trade very differently. What we all have in common is the end goal is to make money within the market. It's almost as simple as that. So anyways, I'll talk to everybody in the next video where we're going to be learning about entries. Yo, what's good everybody? Welcome back to another video in the Day Trading Institution. I really hope you guys have been enjoying this course so far and really learning a lot off of it. I have put so much time and energy into this course and really following your guys' feedback. Now, one thing about the course is that we're always going to have continued videos, but in this video, what we're going to be going over today is stop loss and take profit placement. So just a quick overview of what we're going to be talking about is you as a trader, you already have a process of determining where the market is going to be and what you're going to do when the market is in that area. So let's say that price is currently down here at the bottom, headed towards this range, and let's say price is actually pulled back into this area. You as a trader need to determine where you're going to get out if you're wrong and where you're going to get out if you're right before you take the actual trade. So let's say you're like, okay, well, I'm going to make an entry here. Now you have to ask yourself, where is my stop loss and take profit going to go? My stop loss is going to be under this level of support because if support breaks, I'm going to get out if I'm wrong. And my take profit is going to be at this high because this is the nearest level of resistance and has the highest probability of actually getting hit. And that's how you simply place your stop loss and your take profit. And again, this needs to be determined before you take a trade, guys. Right? Now, let's kind of go over some examples here, right? Realistically, there's many ways we could do this, right? So I'm going to go over stop losses and take profits for fibs, for support and resistance, everything along those lines there. So anyways, when it comes down to actually looking to place a position, I'm trying to figure out how I kind of want to get this done. So anyways, let's say that we have resistance here, right? And it doesn't mean that I'm going to be like giving you actual trade ideas, but let's just say we have resistance here and we as a trader determine, okay, well, all I'm going to wait for is for price to form support. And once support actually forms, wait for my entry candle. And let's just say price came down to here, right? And this is where price is currently trading at. Once you see the engulfing off of resistance, you're going to say, okay, I'm going to enter the market here. My stop loss is going to be under this level of support. And my first take profit is going to be this high up here for 2 times my risk. Why? Let's just leave it at here, right? For 2 times my risk. Now, if price breaks under support, I'm most likely wrong and I'm going to get out anyways. But notice how I'm placing my stop loss under support. You want to literally think about it as, I'm trying to find an example here, right? So I'm going to grab my phone. This is support. My phone is support, right? And you can think about price being a ball. Every time you drop the ball onto support, it's just going to bounce around until either that ball breaks through or bounces up and rejects. So we're placing our stop loss under support to protect our order price again from actually being hit, our stop loss, right? And it's the same thing for resistance, right? So now that we place our stop under support, that is the best area to place it because support is protecting our stop loss from getting hit. Now, when it comes to our take profit, I'm going to target the nearest level of resistance. Why? Because what could happen is price go up to resistance and either consolidate and break lower or consolidate and continue higher. It's one of the two, but you want to play it safe. So we're targeting resistance. Why we're also targeting resistance is because resistance, the nearest level of resistance, is going to have the highest probability of actually getting hit. Now, that's one example that we could use. Let's look for another example, right? So on the 4-hour time frame, let's do a fib example. So we should already know where we're going to be placing our stop losses when it comes to taking a position here on fibs, right? Notice the 618. So here we have resistance, right? So if we're going to take a trade here at the 618 and we see price reject the 50 moving average, I'm not trying to put everything too in detail in terms of the confluences because every trade is situational, but I want to give you guys an ideology where you could place your stop loss on fibs. So let's say I take an engulfing, right? This engulfing here, notice how this engulfing closed under almost at the 50%. My stop loss is going to go a little bit higher than our engulfing because we want to give price room to breathe. You kind of want to put it not, in between completely the 50% or the 618 and the 100%, but you want to put it a little bit lower. You just want to give price enough room to breathe, right? So I'm going to be placing my stop loss just slightly above the 618. Notice here how it's not too tight, but at the same time, it's not too big, right? So that's going to be my stop loss. Because remember, in the situation with fibs, notice how price came all the way back to the 618 before rejecting and then continuing to go down. If you would have had your stop loss too tight, you could have even possibly been taken out by the spread, depending on the broker you're trading on, right? So if you take a trade off the 618, your stop loss has to be above the 618. Now, let's just say, let's also talk about the targets. The targets always on fibs. Our first target when we trade based off of fibs is going to be our 0. Why? Because this is our nearest level of support. Our second target is going to be this negative 27. Why? Because it's an extension lower where we may see price consolidate, and you see here we have support. For your more major levels, right, you always want to look left. Looking left will always give you clues on where your stop losses and take profits will be. Then your third take profit could have been here, and your fourth take profit could have been here, right? So then remember, before you enter a trade, you have to verify the risk to reward. Well, if I enter right now, my stop loss is up here, and my TP1 is down here, I'm going to gain 3 times my risk. Am I gaining over 2 times my risk? Yes, so I'm going to take the trade. Take profit 2, 4.6, take profit 3, 6.6, and then take profit 4, roughly 8 times our risk on this specific trade, right? So now, if you were to take a trade on fibs at the 50% or a little bit under, let's say engulfing, your stop loss has to go a little bit above the 618, right? Why is this? We want to give price enough room to breathe, because if we have a 50% rejection, most likely we're going to enter somewhere along here, and our take profit's going to be somewhere up here. Let's leave it at, right? Your stop loss should be at least around the 618, right? Or a little bit above, right? Now, if you get stopped out at a 50% and price goes to the 618 and starts to consolidate, no problem. You can make a re-entry. Now, if you take a trade at the 38.20, your stop loss should go a little bit above the 50%. If you're wrong, you get back in. If you're wrong again, you get back in, unless price breaks the 618. But again, we want to wait for the right entry signal itself. Now, there's multiple ways we could take different types of setups. I'm going to look for a potential break and retests so we can actually look for this. So here we have a break and a retest of this zone, right? Notice how price broke above the zone, then came back under and engulfed, right? This is the retest and rejection. Typically with a break and retest, you want to set your stop loss just slightly above where the break and retest actually was. And typically your target is going to be the next level of support. So in this situation here, the next target theoretically would be here, but then you could target your next level of support, right? So if we see, let's just make the example, right? I'm going to make an example here, right? Let's just say we see price break this level of support, come up, and then come all the way back down to support, right? And let's just say our entry is here. Our stop loss is going to be under support, and our take profit is going to be our next level of resistance, which you can see is right up here. Now, let's say price breaks under resistance. Notice how price was consolidating above, held at support, broke support, came back up. it retested our previous level of support and it held as resistance. Now, let's just say, let's go down to an hour time frame, right? Let's say you would have made your entry somewhere along, let's go down to the 30-minute actually, because I'm not seeing enough detail on how I would normally trade this, right? Let's just say you would have made your entry somewhere along either this area here or this area. You just know your entry is somewhere in this area here. Your stop loss has to go above your entry price, right? Because remember, we want to place our stop loss above resistance. It's the same ideology as placing your stop loss under support. What's protecting our stop loss from getting hit is that level of resistance. So I place my stop loss above resistance after this rejection. That's my entry point, right? Now your take profit is going to be your next level of support. Now, typically you don't want to set a take profit that's super big and a super tight stop loss, right? Because you want to give price enough room to breathe, because it could come all the way down here, retest it, and then continue to go down. So in a situation like this, I would actually put my stop loss above this 50 SMA as well as above resistance. Now, notice how price is also above this high here, our stop loss, right? That is our previous lower high point within this hour time frame. So we have a decent enough size stop loss and we have a decent enough sized take profit. So that's how we would set our stop loss and our take profit there. Again, right, when it comes down to setting your stop losses and your take profit levels, when you're buying, your stop loss has to be under support. When you're selling, your stop loss has to be above resistance, and your take profit is simply going to be your next level of support and your next level of resistance, right? Now, let's say we're looking for, again, let's give it this situation here. So in this situation here, right, your stop loss would still have to go above resistance, no matter what, right? Even though that the trade didn't play out in your favor, if you were to take a trade off of this engulfing here, or maybe even off of this right here, and you set your take profit down here, your stop loss has to go above resistance. Would I put my stop loss above this wick? No, I feel like that's unnecessarily large, but I would definitely place my stop loss above resistance where I feel as if price has enough room to actually fluctuate, right? And then my take profit again is my nearest level of support, right? So now let's give the trade this example here, right? Let's say I'm going to take this trade here. Right, let's go to the daily. On the daily time frame, right, if I make an entry here off of a 4-hour engulfing, right, I'm going to immediately look at my target. Let's say the engulfing's here. I'm going to look at my target. Here's my target. Next level of resistance. I'm going to place my stop loss under the median of this level of support, because I'm giving price enough room to actually breathe, right? I'm giving price enough room to fluctuate, right? Then you could say the same thing along with here, right? If you enter here, and again, the closer you enter to the level of support or the level of resistance, the better risk to reward ratio you're simply going to have, right? But again, this is why we want to be as accurate with our support and our resistance levels, our supply and our demand levels as best as we possibly could, so we can have the best entries possible and benefit the best off of our risk to reward ratios. Now let's actually go to GJ, right? Because I want to show you guys this trade that I took, right? So initially I had taken a buy position somewhere along here, right? Super clean setup, 38.20 rejection, entry was a little bit earlier. My entry was along this area here. My stop loss was a little bit under the 50% and under this low right here. But notice how I'm going to draw this black line. There's support all throughout here. So I'm placing my stop loss under support and under the 50%. But sometimes there's going to be big stop hunts. And that's exactly what happened here. This was a very big stop hunt. Price came down, grabbed liquidity, and immediately rejected. Now, is the trade still valid? Yes. Why? Because all price simply did was come down into the daily support level and grab liquidity. So yes, buys are still very valid. But again, we're in the holiday period, so trading is definitely going to slow down, but I definitely still could look for a buy. What would I do in this situation now? Notice how I have support here, support here, support here, and then notice how price still closed above this red line, right? In a situation like this, if I'm going to take a trade based off a 4-hour, I'm going to enter around here. My stop loss is going to go right under, a little bit under this level of support. Notice the median, right? Price typically struggles passing this area here, right? So my stop loss is going to go under the median of support, and my next target is going to be the next level of resistance, which is right up here. Very clean trade, very clean setup. And what we can also see is price starting to slowly form bullish structure. What I'm expecting is that 3-leg extension to the upside. So anyways, everybody, just a quick recap. If you're buying, you want your stop loss under support. If you're selling, you want your stop loss above resistance. If you're taking a Fibonacci retracement trade and you enter at the 50%, your stop loss should probably go somewhere above the 61.8. If you're buying at the 61.8, your stop loss should still go above the 61.8. If you're buying at the 38.20%, your stop loss should be going in between the 50% and the 61.8%. Right? So pretty simple setup, pretty simple in terms of stop losses. When it comes to take profits, your take profit should always be the next level of support or the next level of resistance. So if I'm selling, your take profit should be the next level of support. If I'm buying, your take profit should be the next level of resistance. Hopefully everybody understands that video with stop losses and take profits and how you actually place them and the best areas to place them. Again, the best area to place your stop loss at is at an area that's above or under support and resistance. Anyways, guys, it's not something that's too complicated, but I'll speak to everybody in the next video. Alright, everybody, so what we're going to be discussing in today's video is basically just conservative entry signals. So basically, when you see these certain price action or candlestick signals, is basically the sign to give you the green light to actually take the trade. I know a lot of people get confused a lot of the times on when I should get in on the trade and when I should get out of the trade. But to keep things as simple as possible for the sake of this video, when we see these price action signals, these are going to be the signals that tell us, okay, enter sell, or okay, enter your buy position. It's going to be one of the two. Now, we have aggressive and we have conservative entry signals. In this video, we're going to be going over our conservative entry signals. So, with that being said, there's going to be pros and cons for the aggressive type of entry signal, and there's going to be pros and cons for the conservative entry signal. Typically, the cons for the conservative entry signal is going to be that when you actually take the position, since you're waiting for an actual price action signal to print, basically we're looking for the candlestick to give us a signal to take the trade, which will in return give us a lower risk reward ratio because we don't know how big that candlestick is actually going to print. Now, two main things to keep in mind when you actually do take these conservative entry signals, right? First, you have to wait for the candlestick to actually close. You have to wait for the candlestick to actually close itself, because if price is still fluctuating and you assume that the candlestick is going to go that way, that's an assumption and that's you putting your will onto the market. You have to allow price to tell you that, hey, this is your entry signal. This is when you need to be getting into the market. If you do that while price is fluctuating, what can happen a lot of the times is price will give you a false entry signal since the candlestick did not close and potentially go in the opposite direction, and you could have potentially avoided a loss by simply waiting for your entry signal to actually print. Now, the second thing to keep in mind when actually taking these entry signals is that you actually have to wait for the candlestick to close. And by doing that, we don't know how big the candlestick is actually going to be. So there may be times in your trading where you give price time to actually form the candlestick and allow it to close. And what can happen is that the candlestick is actually so large that you may not be able to actually take the position because the risk to reward ratio may be so poor. And that's going to be one of the cons that comes with trading the conservative entry signals. Now, obviously, one of the pros about trading these conservative entry signals is that you're going to have a higher probability entry signal just simply because you're waiting for that price action confirmation to be able to take the position. So if your trade had a 60% chance of winning and had a 60% probability to go in your favor, you may now have a 65% probability of price going into your favor just simply by waiting for these price action signals. So again, the pros is going to be that you're going to have a higher probability entry signal, but the cons are going to be that your risk reward ratio is going to be significantly lower than the entry signals. So with that being said, you're really going to have roughly 4 types of entry signals: your bullish engulfings, your bearish engulfings, your bullish variations, and your bearish variations. So typically with your bullish engulfings or your bullish variations, right, you're going to want to take these positions obviously at an area of support. It's not about the what, more important, it's about the where. You can see random bullish engulfings and bullish variations probably throughout the entire price action chart. But remember, you have to wait for price to get into your entry zone, which typically is going to be a level of support. And then that's when you look for your bullish engulfing or your bullish variation signal to actually buy. Another thing that you can actually look for these bullish engulfings or bullish variations is wait for a break and retest setup. Typically, the bullish engulfings and the bullish variation patterns are going to be patterns that you're going to look for at a previous area of resistance that is now a newfound support level, or at a support level that you're waiting for price action to actually come back down to. And again, the highest probability signal that you're going to be looking for are these bullish engulfings or these bullish variation patterns at an area of support in a bullish trend. Now, for the bearish engulfings and the bearish variation patterns, you're going to want to wait for these patterns at areas of previous resistance on a break and retest of a previous support level that you may be anticipating to hold as a resistance level, or in a bearish trend at a previous area of resistance or a newfound area of resistance. Whenever you think about sell and bearish engulfings and bearish variations, you want to take these trades at resistance. Whenever you think about buys and you're looking at bullish engulfings and bullish variations, you want to take these at support. So with that being said, we're going to go into the actual chart now and look for these examples live. Alright everybody, so we're basically going to be looking for our examples of our bullish engulfings and our bearish engulfings along with the variation patterns as the conservative and entry conservative entry method and the conservative entry signals. So in this video, I'm not going to be too focused on where you should look to get out of the trade, stop loss placement, etc., etc. We're solely going to be paying attention to the actual signals themselves here and when you should be looking for these signals. So in a situation, this is the S&P 500 index, by the way, in a situation where you've identified major support. Also, I do want to keep in mind that we're not going to be also just kind of like telling you what time frames you should be looking for these signals. Ultimately, whatever time frames your trading time frames are going to be is typically the signals that you want to look for. What these signals tell you is exactly the same information, just on different time frames. So what we're going to be mainly looking for here on the S&P 500 are our bullish engulfings and our bullish variation patterns. So I'm just going to go down to a 30-minute time frame for sake so we could find more examples of these. But again, we're going to be looking for our bullish engulfings at our areas of support. So on the 4-hour time frame, what we can clearly identify here is that this yellow line here is going to be a major area of previous resistance and a major area of support. So let's say I was on my 30-minute time frame, which is my active trading time frame, right? What I'm going to be looking for again is a signal to potentially buy and a signal to potentially sell. So the first example of a bullish variation pattern is going to be right here. This is going to be our example of a bullish variation pattern right off of support. Now with this bullish variation pattern, what we have to actually pay attention to is that we have one candlestick, which is our rejection candlestick, and the second candlestick is going to be our entry signal. So right when this candlestick actually closes is when you want to take your buy position. Now, the thing that you have to pay attention to with the variation patterns is that it does actually have to reject our support range, which this is the candlestick that rejected the support range, and the candlestick that closed after that has to close above the high of the previous candle, which in this situation here, the high of the previous candle is going to be right here. This is the highest high. So that is going to be our criteria for our bullish variation pattern is one, we have the rejection of the support range, and to the candlestick after that, which is typically going to also be a bullish candlestick, has to close above the highest high of the previous candlestick. Now this candlestick can be a bearish candlestick as well, but at that point in time, if it's a bearish candlestick, then it'll just be considered an engulfing candlestick, because a bullish variation pattern is actually going to be composed of 2 or 3 typically bullish candlesticks. Now we have another example of a bullish variation pattern being right here. This bearish candlestick is actually the candlestick that rejected support, and then this candlestick pattern right here is actually going to be our entry signal. Notice how price closed above the highest high of the previous candlestick, being this bullish candlestick here. This second bullish candlestick over here is going to be the candlestick that actually confirms our actual, this candlestick right here is going to be the actual candlestick that actually gives us a signal to then take the buy position. So essentially after this candlestick closes is when you'd want to place your buy order here, and we can see that both times price actually continued to go up shortly right after that. And again, you should have already seen the video on support and resistance and where you should place your stop loss and where you should place your take profits. But just to give you guys a quick example of the risk to reward ratios that we're looking at here, if you would have taken a buy position here with your stop loss under support and targeted resistance, you would have had potentially a 2-to-1 risk to reward ratio, meaning for every $100 that you risked, you were looking to gain $200 out of this specific move, which typically the risk to reward ratios just simply aren't the best when you compare them to conservative and when you compare them to aggressive entry methods. Now, when it comes down to a bullish or a bearish variation pattern, typically what we're going to do is look for these patterns that are areas of resistance, which if we go over here, we have the 4-hour level, right? That's where typically we're going to identify our major support or our major resistance levels, right? We're going to mark this entire area off because this is an area of resistance here. We're going to go back down into a 30-minute time frame, and we're going to look at this resistance range over here and try and find some examples of a bearish variation on this 30-minute time frame at resistance. So we have one example of a bearish variation right here, where again the concept is exactly the same. The only difference is that we're looking to actually take a sell. So with that being said, the candlestick that is going to be your entry candlestick has to close under the low or under the lowest low of the previous candlestick, which is going to be over here. After you see that, that is going to be your signal to actually take that sell position. The concept literally stays exactly the same. The only thing you're doing is actually flipping it. Now, when we talk about our engulfings, typically this is going to be a 2 candlestick formation pattern as well, because the candlestick has to engulf the previous candlestick. Now, it has to engulf the opposite candlestick that is actually forming the signal. So if you're looking for a bearish engulfing, price has to engulf a bullish candlestick. So in this situation here, price actually has to close under the lowest low of the previous bullish candlestick, and after this bearish candlestick close is when you would want to take your sell position, which essentially this is the entry candlestick right here. That is going to be your bearish engulfing. Now we can find a bunch of different examples of a bearish engulfing. That is going to be an example of a high probability bearish engulfing because it closed under the lowest low of the previous candlestick. An example of a medium probability bearish candlestick would be this bearish candlestick here. Notice on how this bearish candlestick price just continues to go down straight away after the entry, but on a medium probability candlestick, which is this bearish engulfing candlestick here, price pulled back and then continued to go in the direction of your entry. This is because price closed under, or price failed to close under the lowest low of the previous bullish candlestick, being this candlestick here. So we have our medium and our high probability entry signals. When an entry signal does not close under the lowest low or close above the highest high, that is going to make it a medium probability. You could still take the entry, but again, it's just not as high of a probability as the previous entry signals, which close above the highest high or close under the lowest low. So that is going to be an example of a bearish engulfing. This is going to be another example here of bearish variation, and these are all areas, these are all forming at an area of resistance, which is more important. Again, you want to look for these entry candlesticks at these areas of resistance. And then here you have another example of a high probability bearish engulfing candlestick pattern, which did close under the lowest low of the previous candlestick, being this bullish candlestick right here. And if we were to continue this, we now have another entry signal over here being a bearish engulfing candlestick right here, which it did close under the lowest low of the previous candlestick. And then shortly after that, you have another example of a bearish variation. But then keep in mind, if you were to wait for this bearish variation, you could have taken the entry signal after this engulfing, or you could have taken the entry signal after this variation pattern. But keep in mind, your entry would have been here on an engulfing and down here on a variation, where if you would have taken just a simple rejection, your entry could have potentially been up here. So again, pros and cons. Now, again, I don't want to drag this video along because all we're simply doing is looking for the pattern. But again, here we have a major area of support right here, right? This white line is going to be support. Notice price closed back above support and then price closed above here. Although this may look like a bullish variation pattern, it is not our entry signal because we're waiting for price to close above the highest high of the previous candlestick, which this candlestick did not do so. This is a medium engulf, or this is a medium probability bullish engulfing candlestick signal. Remember, our most desired entry signal is going to be a high probability entry signal. So although yes, you could have taken the position on a buy right after price closed here, if you were to wait for more confirmation being an engulfing or a high probability bullish variation, then essentially we have to wait for price to close above the highest high of the previous candle. So this could have been your signal to potentially buy, and if you didn't take that buy and you're waiting for price to close above the highest high, then your signal to buy would have been here. Why? Because this is the highest high of the previous candlestick. Notice this candlestick did not close above. Now this is the highest high of the previous candlestick. Notice that this candlestick did not close above. Same thing goes over here. Now, although this candlestick did close above the highest high of the previous candlestick, which is pretty much this doji right here, it's not the best candlestick to actually enter a position on because you'd want to wait for the break of the highs, essentially, which this candlestick would have been your entry candlestick pattern right here, which it did close above the highest highs. Notice once price actually did that, consolidated for a bit, but then continued to actually go up and make new highs. So when it comes down to a bullish engulfing candlestick pattern, the concept stays exactly the same, right? We have a nice bullish engulfing candlestick pattern, which price did close above the high of, or the highest high of the previous candlestick here. So it's going to be a bullish engulfing, and then you have a bullish variation pattern right here, right off of this major area of support, as you can see. Now, if we look at other examples of bullish engulfings, you have a great example right here of a bullish engulfing, where notice price just completely closed bullish and it closed above the highest high of the previous candlestick. So those are going to be examples of bullish engulfings, bullish variations, bullish or bearish engulfings as well. Then here's another example of a bullish engulfing where we had price close above the highest high of the previous candlestick. Now, those are going to be the examples of the bullish and bearish entry signals on a conservative method. In the next video, we're going to be talking about more of an aggressive method, and then in the video after that, we're basically going to be breaking down the pros and cons in terms of risk to reward, and then you can look to identify which setup you want to allocate a conservative entry method to, or which setup you want to allocate an aggressive entry method to. Alright guys, so now in this video we're going to be pretty much going over aggressive entry methods, which there's not a lot of different candlestick signals like the bullish variation, bearish variation, bullish engulfing, bearish engulfings. Instead, an aggressive entry is formed on a rejection. So whenever you see price come to a major support level or a major resistance level and you start to see rejections, those are basically your signals to enter the market. So obviously on the screen here, you're going to see an example of a bullish rejection. Here's another example of a bullish rejection. Or if we're looking to sell, then here's an example of a bearish rejection. Then here's an example of another bearish rejection. So those are going to be like the different forms of rejections. Now we're really going to go into the market and look at the different types of rejections that you're going to see in the market. It's not just kind of those two examples, but again, it's all a rejection. So basically what we're looking at is we're looking for these different types of entry candlesticks that are all just rejections. So I mean, we're on the 4-hour time frame here. I don't trade a 4-hour time frame, but I'm going to go down to a 30-minute time frame, and we're going to look for basically opportunities where we could look for these entry candlesticks being these strong rejection candlesticks. Now, actually, let's go to a 15-minute time frame. So 15-minute time frame is typically the time frame that I look for these aggressive entry methods, this aggressive entry method. So we're going to be able to find actually a few here. More importantly, what we actually have to look for is for the resistance range. Now, again, when it comes down to these aggressive entry methods, what we look for is simply just a rejection. So this is an example of an aggressive entry method here. This is an example of a non-aggressive entry method. So there's two differences here. When we're actually looking to take a short position, right here, this example right here, this candlestick pattern would be your sell signal. Why? Let's just say price came up into an area of resistance, which it didn't really in this situation here, but I'm just showing you guys the examples. If price would have come up into resistance and given you a huge wick to the upside like this with a doji candlestick, then that is an example of a rejection, and essentially you'd want to enter right when this candlestick actually closes. This is the complete opposite. If we saw this at support, it would be a different story, but since this is at resistance, this is not an example of a rejection because we have a rejection to the downside. We want to see a rejection to the upside when it comes to resistance. And again, the bigger the rejection, ultimately the higher the probability of price to go in our favor. Now, when it comes to this candlestick over here, this is another example of a rejection where essentially right once price actually closed is when you would take the sell position. Now, let's actually go down into a possible area of support. So we have support all throughout this entire range right here. This is going to be our support level we're actually going to be looking at here. So notice how price came into support and then gave you the rejection and actually closed. This would be your entry signal right here, right once this candlestick actually closes, along with this candlestick too. If this candlestick closed here with the rejection and support, this would be another entry signal there as well. Now there's two differences. In this candlestick, you're entering on a bearish candlestick. In this candlestick, you're entering on a bullish candlestick. More importantly, they're telling you the same exact thing. Price came down into support and sellers were met with buying pressure, and we saw price actually reject this area of support, giving us the entry signal. So this would be a great example of an entry signal here. Now, this can also be an entry signal as well, just simply because price came down into support and rejected. Now, when it comes to an entry candlestick, typically what I like to see is price close at around the 50% mark of the rejection. What do I mean by that? We're going to be looking at the open of the candlestick, and we're going to be looking at the lowest low. If price closed about halfway from the candlestick lowest low, which is the lowest point price actually reached, or the lowest point the wick actually formed, to about the halfway mark, then that is going to give us our rejection, and that is going to give us our signal to actually enter the market. Anything above that 50% mark, I wouldn't actually enter. So notice on this candlestick here, price opened over here, but then closed here, but then the lowest low is all the way down here, went under that 50%, which typically is a great rejection signal. That's a signal that you would want to take to actually look to take that sell or that buy position. Now, again, here's another example of resistance, right? So this would be another example of an aggressive entry method where price came all the way up into resistance. We have price actually open up here, close here, and this is the highest high in this situation here where we're looking to actually sell. In a situation like this, this is essentially where you would make your entry right once this candlestick actually closes as an aggressive entry method. That is when you would want to enter the position on a sell. So here's another example of an aggressive entry candlestick that you could potentially take that buy or that sell position on. Now, vice versa, let's flip the roles, right? Price was going bullish, price closed bullish, and then price came down, tried to close back under resistance, but instead resistance actually ended up holding as support, and we saw price actually reject that area of support. This is another example of an entry method where essentially price tried to close back under resistance, resistance did not hold, then it actually held as support. And in this situation, you would actually take a buy right when this candlestick closes. You can see the next candlestick came back down, retested, and then went bullish right after that, which is great. Now here's another example over here. Notice price consolidating above support. Price came all the way back down, rejected, closed, and at this point in time is when you would make your entry right once this candlestick closed under that 50% mark from the open to the lowest low, and price went bullish right after that. Here's an example of a sell opportunity where essentially we have resistance all throughout this entire range over here. We had price all the way pump up into resistance, gave us that rejection. Here's the open, here's the highest high, here's where price actually closed under that 50% mark, and then that's when you would want to make your entry. And as you can see, after a few hours later, price ended up dumping to the downside. So those are going to be a few examples of just some basic rejections. We're going to go over a few more here, but again, the concept comes down to we're looking for these rejection candlesticks at resistance. We're looking for these candlestick rejections at support. Now, this would not be an example of an entry candlestick because it did not close under that 50%. But there's going to be a lot of times where it may close under that 50%, but prices move too far away from our resistance level for us to want to actually take the position. So in this situation here, this is definitely a sell signal, but what you have to consider is your stops have to go above the high here. So if the risk to reward makes sense, essentially right once this candlestick closed is when you'd want to make your entry. But for the sake of the video and example purposes, this is what you would want to look for right at resistance. This is an example of a sell. Now we're going to continue. Let's continue looking towards the downside. Let's say we have support all throughout this range here, which essentially this would be a little bit of a trickier area to look for the entry signals here. But an entry signal would essentially look something like these two candlesticks here, where if we look at it in this form here, let's say this was major support, notice all of the rejection you're getting towards the downside. The entry signal really would have been around here as well, because they both close under that 50%, tested support, rejected support, and then this is when you'd want to make your entry there. But again, it's just for example purposes. This would be another great example of a rejection here as well. This candlestick right in the middle, this doji candlestick, especially when the price gives you a huge wick to the downside and you're looking to buy and then closes bullish, that's typically a great sign for you to actually look to take that buy position. Now I'm going to go back into the past a little bit. This is another pretty good example when you could actually look to buy. You see price come all the way down. This is the support range we're looking at. Price closed right above support, then you have a huge rejection to the downside, and price closed above that 50% mark, where essentially this is where you would make your buy here as well. Now this can get a little bit tricky at times because essentially here you have a rejection, which is a pretty good rejection. You could have taken a buy off of this position here, but this is just a position that ultimately if your stop loss placement was too tight, you would have ended up losing. But I also want to show you guys the examples of a loss. This necessarily wouldn't have been a bad entry, but one thing to keep in mind is all of the rejection you have towards the upside. If you're looking to buy and you have all of this rejection towards the upside and not much rejection towards the downside, then that's simply not an entry that you should be taking. Although I wanted to get kind of the confusion out of the way, because although it is a rejection candlestick, it's not like the strongest form of a rejection candlestick. Now let's keep in mind, we're looking to essentially buy on this candlestick right here. Notice all of the rejection towards the downside. There was very little upside rejection there. So these are all different things to actually keep in mind. Now I want to try and go over another example. I want to go over the cleanest examples possible. I mean, you could look at this as another form of a rejection right here, right? Once price came up into resistance, gave you a rejection, you would sell right then and there. The most important thing about these rejection candlesticks, I'm going to switch the pair. The most important thing about these rejection candlesticks is you have to see them form at resistance. If they don't form at resistance, then essentially if they don't form at support or resistance, it's going to be a very high risk trade. You want to actually see these candlesticks form at a support level, at a resistance level, such as this candlestick here. Notice how price broke above, came back down, retested, rejected support, and gave us kind of that closure above the 50% mark, showing us a pretty good rejection towards the downside. Right then and there is when you would actually want to buy, and then you can see price continue to go up. Now, a quick example. If you were to wait for a conservative entry method, right, your entry would have been up here versus your entry with a rejection would have been down here. So look at the big difference in entries. This entry would have suffered massive drawdown. This entry you would have just been at most a break even, which is a pro of using the aggressive method. But then at the same time, like we'll go over like the pros and cons in the next video, and then the video after that we're gonna go over tying everything all together. But I just wanted to kind of show you guys different types of entry methods. So obviously throughout your trading experience, you're gonna understand what entries to take that are aggressive, what entries to take that are more conservative. But ultimately, you're only gonna get good at recognizing these entry methods with time and experience. Those are the biggest things. Those are the biggest things in the markets, and understanding how trading actually works, and technical analysis. Because again, technical analysis is a skill that you're going to learn over a period of time, especially if you practice every single day and you actually get good at it. So with that being said, guys, I'm just going to wrap up this specific video here. In the next video, we're basically going to show you guys live chart examples of pros and cons of the entry versus the conservative method. Alright everybody, in this video we're basically going to be going over the pros and the cons of using the aggressive entry method versus the conservative entry method. When you're trading more conservatively, obviously, and you're using the conservative entry method, your risk to reward is going to take a hit, meaning that when you actually take these conservative entry methods, since you're waiting for the candlestick to actually print, the candlestick could be a very large candlestick, or the candlestick could be a decent sized candlestick. But essentially, like, our goal as a trader is to try and get into a trade as close to the support or the resistance range as possible, so that we can obviously increase our risk to reward ratios, essentially decrease our risk while increasing our reward. Now, when we wait for a specific candlestick to actually print, and then we see the candlestick obviously move away from support and actually close, or move away from resistance and close, what you're doing is you're increasing your stop loss size, which essentially your targets, depending on the trade, may or may not increase. So you're increasing your stop loss size, and your target is going to stay roughly around the same, and you have to take the trade that way. So you're going to be decreasing your reward ratio in return, which is going to be the con. Now, the pro of this obviously is going to be that you're going to have a higher probability entry setup, you're going to have a higher probability trade, and you may even actually increase your win rate just simply because you're waiting for specific signals to tell you that, hey, the market is now going in this certain direction, let's take the trade in this certain direction, right? That is going to be the two pros and cons there of the conservative entry method. The only really pro that I see is obviously you're going to have a higher win rate, you're going to have a higher probability trade. And then with the con, obviously, is that you're going to be decreasing your risk to reward ratio while also increasing your stop loss size. Now, with the aggressive entry method, the pro is you're going to significantly increase your reward ratio because you're now using a lot smaller of a stop loss. That is going to be one pro. The other pro is that you may actually see less drawdown in a trade, which will obviously allow you to have a more logical state of mind. You're not going to see a loss much on your P&L, so it'll possibly allow you to hold the position for longer, which is going to be another pro. And then obviously another pro with that being said is that typically when you actually trade with an aggressive entry methods, a lot of the times is you're going to have a lot smaller of a stop loss, because even if you put an aggressive entry with a conservative entry and you guys take roughly an entry on the same move, your stop loss size or your stop losses are going to go in the same area. But obviously with the entry or the aggressive entry method, your stop loss is going to be a lot closer to that support or resistance range, versus the conservative entry method, which your stop loss is going to be a lot farther from that support or that resistance range. Now again, the pro is you're going to significantly increase your reward ratio, which is the biggest pro. Now, your pro as well is going to be that you're going to also decrease the size of your stop loss. The cons. Now, the cons are you may potentially lose more positions because you're entering very aggressively, but the reward ratio will make up for that, and you actually may even decrease your win rate a little bit. But again, the reward ratio will completely make up for that. So now we're actually going to go on the charts, and I'm going to give you guys examples of exactly what I'm talking about here. All right, guys. So just to give you guys a few examples of basically what I'm talking about here is in this situation here, we have price break above resistance, which typically when we see price break above a previous level of resistance, that is a bullish indicator. We have price break above resistance, make new highs, pull back down, and reject resistance. Now, in terms of the entry signal, right, this is going to be an aggressive entry signal here. So right once this candlestick actually closes, that is when we make our entry, because price closed above that 50% pullback rate in a bearish condition. Obviously in a bullish condition where you're looking to actually sell, in that situation you want to see price pull back under that 50%. But obviously if you're looking to buy, you want to see price go up 50% from the rejection. So in this situation here, you would enter off of this candlestick rejection here, which now your stop loss has to go under the low, which is going to be this low right here. Now this gives us a lot of room for our targets. Even if we were to just target the high before we saw the pullback, that would give us a 2-to-1 risk to reward ratio. I'm going to flip this to the other side just to show you guys this is the aggressive entry. Now with the conservative entry, by the time you make the entry and you place your stop loss here, the aggressive entry is already up a 2-to-1 risk to reward ratio. With the conservative entry, you may not even be able to take the position, just simply because price moved too far away, right? So let's just say we had a bigger target being the next area of resistance, which essentially, realistically, it would be right here, right? So by the time you make your entry, you're not even going to get a 1-to-1 risk to reward ratio with the conservative method. So I'll give you a real life example. Essentially when you buy at support, you want to target resistance, which your resistance level is going to be roughly in this range over here, right? Your aggressive entry is going to be in a positive risk to reward of a 3-to-1, but your conservative entry, you're at a risk to reward ratio of 0.53, meaning for every single $100, let's call it, that you risked, you're only up $50. From every single $100 you risked, you're at a negative risk to reward ratio. So with that in mind, it's not even going to be a positive risk to reward ratio, and it's not going to be worth taking the position. While the aggressive entry method, you would have been up 3 times your risk, meaning that every $100 you risked in the market, you're up $323 in this situation, which is great. Now let's say we shot for the moon and we're targeting this area of major resistance over here. On a conservative entry, you're only up 2 times your risk on a huge move. In this example, we're obviously going to go over a few more examples, but in this example, you're only up 2 times your risk, which again, if you risked $100, you're only up $200. On the conservative entry method, on the aggressive entry method, you're up 7 times your risk. So for every $100, you're up $700, which is a huge difference. You can already see the massive pro and the con between the aggressive entry method and the conservative entry method. So even if you would have lost, let's put this into example, even if you would have lost the previous 2 trades in a row, right, and you take this position, you would have made those 2 trades back plus an extra 5 reward multiple. Meaning that instead of being up a total net of, call it $700 if you risked $100, you'd be up $500 because $200 of that gain made back your $200 losses. Versus on a conservative entry method, you have a bigger stop loss. You have to hold the trade for a lot longer because remember, if you're targeting this area for a 2-to-1 risk to reward ratio, your job is to try and hold for as long as possible for a 2-to-1 risk to reward ratio. Versus with the aggressive entry method, you could have gotten out at a 2-to-1 here, you could have gotten out here, you could have gotten out anywhere in between, right? Let's say you would have gotten out at the top and you would have hit a home run trade, you would have hit a 7 reward ratio or a 7 arm multiple, versus you trading conservatively, you've only would have made a 2 arm multiple, which there is a huge difference. Now, I'm going to look for another example over here. I'm going to kind of look for a sell example, which we could look for one around this area over here. So I'm trying to give the most like clear, crystal cut examples here as well. So right here, okay. So now let's say that you would have been looking to take a sell anywhere along this, anywhere along kind of like this area over here. Right, let's say price would have came up into your resistance range and you would have hit that sell button right then and there. This is kind of an example where the risk to reward ratios would roughly be the same. Most of the time it's not going to be like this though. So in a situation here, let's say you would have entered the trade right here off of an aggressive entry signal, and you would have put your stop loss somewhere around this area over here, kind of above these highs. So if we've identified that this orange line is going to be resistance and we see like highs over here, that's typically where you'd want to place your stop loss. Let's say you would have had a target over here. I mean, in this situation, you would have had a pretty roughly the same arm multiple. I mean, your stop loss size would have been just slightly different. In the first position, you would have gotten 7 times your risk. In the second position, you would have gotten 6.3 times your risk. Now, things significantly change over here, where on this situation, you would have actually had an entry opportunity right here. Let's call it your stop loss would be roughly in the same place. Your take profit being down here. And let's say you would have taken an entry off of this retest, which notice how price came all the way back up, retested resistance and rejected and closed at about the 50% mark. This is where you would have taken your sell position on the aggressive entry method, because these entries right here aren't the greatest for an aggressive entry, obviously, because they don't meet our criteria. Right, in this situation here, on the aggressive entry method, you would have made 4.4 times your risk, meaning if you would have risked $100, you would have made $440. And on the conservative entry method, you would have made roughly $285 for every $100 you risked. Now, obviously you can see the pros and the cons there in the risk to reward ratios, but let's also look at this from a trade management perspective. On a conservative entry, you would have seen about a 50% drawdown, versus on a aggressive entry, you would have seen about a 25% drawdown, not being a lot at all. And that's a 25% drawdown after entry that you only saw once. Maybe then you saw like a 10% drawdown right after that, but you went straight into profit right after that. Also notice that right once price was already in profit for your aggressive entry, price was just at break even for your conservative entry method, which is, again, huge. These are all different things that are going to affect your trading psychology when you see drawdown, etc., etc. And now keep in mind here, we saw price go about 50% of the way to the target, and then price pulled all the way back. If you would have continued to actually hold and you didn't get out at either break even or you didn't get out in profit, right? Let's just look at this from a perspective of, you know what, I'm up a good risk to reward ratio and I'm going to get out. On an aggressive entry, you could have potentially gotten out at a 2-to-1 risk to reward ratio. On a conservative entry, a 2-to-1 risk to reward ratio turned into a 1.5 risk to reward ratio. And by then, price pulled all the way back. You would have seen drawdown on, you would have seen like maybe a 25% drawdown on the conservative entry. On the aggressive entry, you would have seen roughly a 5% drawdown before your targets actually got hit here. Now let's go over another buy opportunity, which again down here, let's say you have major support, right? And price gave you the rejection right here. So essentially this is where you'd want to take the position. No previous price action data. So I'm just going to place my stop loss here under support. So the entry, the aggressive entry method is going to enter off of this rejection because it closed above the 50% rejection mark. Stop loss under support. Let's kind of put it here. Take profit's going to be resistance. We're looking at a 3-to-1 risk to reward ratio here versus on an engulfing entry method, my apologies, right? Our stop loss is going to go exactly in the same place and our take profit is going to go in the same place here. Here, you're barely scraping a 2-to-1 risk to reward ratio. Here, you're getting a 1.9 risk to reward ratio versus on the aggressive entry method, you're getting a whole R multiple being a whole 3, actually more, you're getting 3.34 times your risk. So, in example purposes, when you're trading larger capital, right, and let's say you're risking $10,000 on this position, you would have risked $10,000 to make $33,400 on this trade is how much you would have gained. On this position, you would have risked 10 grand and you would have made $19,700. That is a huge difference. I mean, you're talking about an entire mortgage on a reward ratio. Again, pros and cons. Which trade has a higher probability of winning? This one, because you had already gotten the conservative entry, you already gotten the buy signal right here, versus here you had just gotten a simple rejection. So you have to keep those things all in mind. I'm going to go over one more example here. So here we have a nice break and retest setup, right? Which obviously, in the part of the course, I believe that's coming in the next section. We're going to be going over the setups themselves. Here you have a break and retest setup, right? Notice how price came up into previous support and actually held as resistance. Your entry would have been on a short position right after that bullish candlestick closed. Stop loss would have gone right above the bullish candlestick high. Targets would be support. So you're already looking at a 4-to-1 risk to reward ratio. By the time you enter off of an engulfing candlestick, with your entry off of the engulfing, your stop loss in the same exact place, you maybe not even have been able, you maybe wouldn't have even been able to take the position because you're only getting 1 times your risk. So if you risk $100, you're going to gain $100 on this trade. Versus on the aggressive entry method, if you would have risked $100, you would have gained $424. Again, you can already see how the pro significantly outweighs the con of taking these types of entry signals. And again, in this trade, if you would have risked 10 grand, you would have made 40 grand. If in this trade, if you would have risked 10 grand, you only would have made 10 grand. But again, you have a lot higher of a probability of winning after you took the entry here. So just want you guys to keep all of that in mind. And also keep in mind that price could have easily pulled back. You could have been a 50% drawdown, while here you would have been just chilling in profit, and then price could have gone down. Like, there's so many different scenarios you could have potentially looked at here. But I just wanted to show you guys again the pros and the cons, to give you guys some live chart examples of the pros and the cons of the entry versus the conservative aggressive method of entering the market. These types of signals. Hopefully you guys did enjoy this video. Hopefully it did help out and give you like a clear view of what direction you kind of want to enter the market on. Other than that, I will talk to you guys in the next video. Alright guys, so in this video, we're basically going to be tying everything together. You've learned about stop loss placement, you've learned about take profit placement, and you've learned about different entry signals. Obviously, in the next sections, we're actually going to be going over the specific setups, but basically what I want to do is tie everything together that you've already learned, which is stop loss placements, take profit placements, and then our entries. So, looking into the market here, we're going to be looking at the S&P 500 index, right? You always have to take into consideration, obviously, the trend and where the market is currently trading at. You know, you want to always look at the price action and everything else, but as of right now, for the simplicity of this video, what we're simply going to be doing is basically looking at stop loss placement, take profit placement, and then entries, and how you could formulate and put those 3 different concepts together to ultimately capitalize off of the moves you see in the market. Now, for me, I trade a 5 and a 15-minute time frame. I mean, I use all of my time frames together, but I predominantly trade a 5 and a 15-minute time frame. So in a situation where I see prices overall going bearish and we've broken under a major area of support and prices pulled back into that previous area of support, what I'm going to be looking at is, 1, where is our previous low in the market? I'm going to be identifying the actual trend. So our previous low in the market after prices actually pulled back is going to be down here. What we can also identify is that price had actually broken under this major area of support. This is already going to create a pretty good probability for price to continue to go down, because price is actually rejecting this previous area of resistance here. Now, there's multiple examples that we can actually look at here, but again, what we're going to be focusing on is entry, stop loss, and take profit placement. Now, in this situation here, what we actually see is price pull back and give us a rejection of our previous area of resistance. Now, obviously, if we were in session, this would be a pretty good entry signal here. Now, in a situation where, let's pretend like we don't already know what's happened, in a situation where you see this rejection that we have over here, and we see this over here where notice price broke under, came back above, and then continued to go down, Your stop loss placement should be above the highest point that price actually gave you when it rejected. So since this is pretty close in proximity, I'm going to take an aggressive entry position right off of this rejection that you see here, and my stop loss is going to go above the high over here where we had price break under, form a high, then continue to go down. That is going to be a safer stop loss placement. Why? Because I'm taking into consideration that my take profit's going to be all the way down here. So I can be greedy and place my stop loss a few points above this resistance that we've seen here. But since my target is so big, I want to allow price to actually breathe and be able to give price room to actually consolidate before going down. So in this situation, if price breaks above this high here and our current high, then I'm most likely wrong anyways, and I want to exit the position, and that's going to be here. Honestly, stop loss placement is always going to be very subjective to the position that you actually take, but one thing that should never be subjective is your targets. Your targets should always be the next low, anywhere between the range of the close and the lowest point of the wick, which in this situation, I sold that resistance in a downtrend off of an aggressive entry. My stop loss was right above resistance, and my take profit was the nearest area of major support, which, as you can see, that position was actually then hit. Now, let's kind of continue here. Now, let's say in this situation, we actually see price break back above this major area of support here. We're going to zoom out and identify where our nearest major area of resistance here, because now we're looking to buy. So since our next major area of resistance is going to be this entire range that we see here, this is where I'm automatically going to look to take profit at. This is where I'm going to be looking to close my position. Now, if we see that price gave us a nice entry opportunity here, call it that we see price ended up coming down, giving us a rejection, or coming above and giving us a conservative entry method. Let's say that we would have taken an aggressive entry method, because if you would have taken a conservative entry method, again, you have to see price give you a close above the highest high. In this situation here, since we're buying, we're going to be looking to take a close above the highest high right about here, with our stop loss under this low right here, the lowest point price hit before moving away from the actual support range. So I'm going to give you guys two examples here again. Right, in this situation, we're barely going to squeeze a 1.5 risk to reward ratio on a conservative entry method. On an aggressive entry method, where you could have potentially taken a position, let's call it right here, because I had that 50% close above, you would have made potentially a 2 to 8 risk to reward ratio, with your stop loss under the lowest point that price rejected before moving away. And again, our take profit is our nearest area of resistance, which is going to be over here. Now, notice how I could get greedy and say, yeah, you know what, I'm going to shoot for this area of resistance all the way up here. Price has a lot higher of a probability of hitting your nearest area of resistance before doing anything else. So when price has a high probability of hitting this area, that's where you want to take your money off the table, because look what happened shortly after. Price had a huge pullback back to break even, where ultimately, I mean, it would have hit this target, but you could have closed this trade here and gotten out very safely on a perfect kind of exit here. Notice my stops were under the lows of support, the lowest point price had actually reached before going up. Entry method was an aggressive entry over here, conservative over here, and my take profit was nothing greedy, high probability take profit at my nearest area of resistance. Now, I'm going to give you guys an example. Let's say that price on this bearish candlestick would have came and gone all the way down to here and then closed up here, rejecting support, and price would have actually came down and rejected support here. What I would do is I would put my stop loss under the second lowest point, because this could have been a liquidity grab, this could have been news. You don't want to kill your risk to reward ratio for no reason. Remember, you want to set your stop loss in an area that will invalidate the trade. So that's going to be subjective to you and what price action looks like at that moment in time. So that's another example over there. Now, I think what we could do is set another example over here, kind of on a counter trend, just to give you guys that example. So along this area, we have our major area of support. Now, we can take an aggressive entry signal off of this area here, which is not the strongest aggressive entry signal, but you can definitely take it. If we tie down like our 5-minute time frames and use multiple time frame analysis to see what's going on here, we can also use that as well, which essentially we see a little bit more details in price action. But for the sake of this video, I'm just going to kind of go off of this area here. So now we've hit a major area of resistance and we have our aggressive entry signal. We could take the position right then and there. Let's call it right here is where we're going to take the position with our stop loss above the high here. In this situation, I wouldn't, since price like literally tapped into resistance and rejected right away, what I would do is I would kind of place my stop loss at an area where the risk to reward makes sense and the stop loss still makes sense. I'm not going to place my stop loss all the way up here, but if I place my stop loss kind of like around this area right here, I'm still going to get 3 times my risk, which is perfect. So this is where I'm going to set my stop loss here. Because remember, like in this situation, since price kind of tapped into support or previous resistance and it rejected, you still want to give price enough room to, let's say if price were to go for another retest, you know, it can definitely go above, and that's where you want to give stop loss a little bit more room to actually breathe. Now, let's say you would have taken an aggressive entry or a conservative entry here as well. Stop loss goes in the same exact place, and in this situation, you've actually could have placed your stop loss a little bit lower, but for example purposes, it would have gone up here. Your target is still going to be your nearest area of major support, which is going to be our previous area of resistance, which I could have targeted my major area of support. But again, it comes down to probabilities. Your nearest area of major support has a lot higher probability of getting hit before your major area of support or resistance that is a further distance away. So in this situation here, we would have gained probably 3 times our risk. Over here, you would have gained 1.3 times your risk. So you could just kind of see the pros and the cons of the stop loss placements with the aggressive entry and the conservative entry. But again, your goal is to, if you take a position, you're taking your trade at resistance or at support, your stop loss has to be above that resistance range, because when price goes above your resistance range, your stop loss is at an area where it will invalidate the trade and you will close your loser short. If you're buying, it's vice versa. Your stop loss is at a place under support where if you take the position, price will then come down, invalidate the trade, and then close you out of your trade. Remember, the key component to stop loss placement is your stop loss placement has to be at an area where once price hits that area, your trade is no longer valid. And your targets are going to be the nearest area of support or the nearest area of resistance. And if you have a positive risk to reward ratio with your buy or sell signal, then that's when you use those 3 key components together to ultimately give you a high probability trading setup.